Mohammed Apabhai is the head of Asia trading strategy at Citigroup. He says that Asian markets could rally hard until middle of April. But there is a caveat. Mo, thanks for joining us. You have a PhD in mathematics from the University of Oxford. Therefore, that means you're very, very intelligent, right?
That doesn't help you in the markets, though.
And your goal is maths, adding up, clearly. Much more to I'm sure, the PhD level.
Yeah.
Adding up, though, the euro crisis, the contagion. You can say, we'll contain Greece just about. Then you've got to go to Portugal, Spain, Italy, and right across the region. Yeah. It's almost impossible, unless the ECB continues to pump money, for this situation not to see at least one or two defaults, or indeed an implosion. And with that, a banking implosion.
Well, I think the point here is that the ECB has shown that it is far more flexible than anybody had given it credit for. If you look at the statements that they made last year, almost everything that they said at some point or other that they wouldn't do, they actually came out and they've done. So with the ECB, I think we have to keep in mind that we should look at what they're doing rather than what they're saying. The provision of liquidity is coming into the markets at exactly the right point. And what this is very much a liquidity-fueled rally. It's coming from a near-death experience that the market had. And although in the US and in volatility markets we've actually normalized, in Asia we're still some way away from those normalization levels. So we're nowhere near euphoric levels even now.
Well, no, the maths does not add up. You cannot bail out these countries with vast amounts of billions of... Where's it coming from?
Well, this is the thing that these
bonds they haven't paid back yet.
Yes. Well, it's effective quantitative easing. In fact, some would argue that it's super quantitative easing in the sense that
which is a false economy.
Which perhaps, but for the time being, what it does is it averts the imminent crisis. And what that will do is it will buy more time for the central bank and for the governors. So, for example, you see with the Greek deal, we now need to go to 2015, and the Greeks will have a fiscal surplus, or at least they're promising us one of those. What we're doing is we're buying time, and at the moment what we're seeing is that money market stress, which was a very significant factor in the fourth quarter of 2011, has significantly relaxed to the point of almost going away.
Next 6 months, what do you see? Do you see a Greek default? Do you see a banking crisis?
Actually, I don't see any of the above. I think that what we'll see is the continued provision of liquidity. The LTRO, of course, on February the 29th will inject far more money into the market. You know, if we look at what's happened in January and so far in February, all as a result of 489 billion euros, you've got at least that much coming again. So we think that people are still underweight in equity markets. There'll be the quarter-end rally, and then that will continue into April, and maybe this year is a year where you do really sell in May and go away.
I'm going to begin by saying what I ended off with saying. You said sell in May and go away. Now, for those who don't know, when you come back, it is St. Leger's Day. Am I right, Mo?
Yes, that's right.
There you go. For those into racing, St. Leger's Day is actually September the 12th to the 15th this year. So sell in May, go on holiday, and come back in September. Yep. Then you're going to see a late rally because of the US elections.
Correct.
That's your call. So between May and September, what do you do?
Well, I think that you probably want to go and hit the beach, because I think what's going to happen is that all the people who are very worried about the markets right now will be forced to buy into the market into March. That momentum will carry on into the middle of April. That will potentially provide us with a very good selling opportunity for the market then to trade sidewards to probably downwards as we get potentially another growth scare in the US or somewhere in China or maybe even Japan before things start picking up for the US election and the end of the year rally.
Let's talk about China.
Yes.
Now, earlier this week, I've been going back this all week to the boringness of my colleagues. They can say, stop talking about it. IMF, though, did come out with this dreadful warning saying that if Europe hits a deep recession, then that will halve China's growth to about 4%.
Sure.
Does Mo agree with this, or do you think that perhaps that's far too ridiculous a call to make?
No, of course, if the US or China or potentially even Japan hit a very hard recession, then which is less likely than it was 6 months ago. I would argue that without the support from the ECB, it would have made it more likely. Now remember, the estimates of LTRO2, this is the financing package that is going to come out on February the 29th, are anywhere between 400 billion euros and 2 trillion euros in the market. Now, if you get an LTRO number around 1.3 trillion euros, then the total LTRO program will be larger than US QE1 plus QE2. And so there is a huge amount of money that is being provided into the markets. It's one of the reasons why the credit market is rallying so aggressively, is that, yes, there may be a recession in Europe, but maybe not as hard as what people think.
Okay, based on those fundamentals, before May and before you go away, what do you buy? Buy into the stocks rally?
Yes, I think you have to buy into cyclicals, you have to buy into interest rate sensitives, you have to buy into financials, materials, IT, you have to sell out of the defensives and the utilities and the telcos. That's basically been the pad that we've seen since the start of the year. Our clients bought the most shares in January that they had done since the start of the rally. They're on track this month to buy the second highest amount since the start of the rally. So the money is definitely coming in, and it's just going to continue coming for the time being.
Why don't we start talking about what happened in China with those trade numbers that came through? So we did see a drop, the first drop, I believe, in exports for 2 years. But then, you know, I'm more concerned about the import numbers, which fell about 15% in that month. What's going on for the, I guess, the export picture in China?
Well, I think the picture is very much one of some softening, but this was something that we already knew about. What the Chinese authorities are now doing is they are not tightening anymore, and that has come as a big relief to the market. The question now is when they actually start loosening outright, and there's some signs that they're prepared to do it, but they just want to see what the impact of what is going on in Europe right now, especially the addition of liquidity, what impact that's going to have on inflation domestically.
But the import numbers don't suggest to you that maybe the Chinese are not spending as much as they used to? I mean, it was a Lunar New Year, wasn't it? Shouldn't they have been spending more?
They probably should have done, but we've got to remember that policy has been tightened fairly aggressively in China. So, you know, property prices lower, we all feel a little bit poorer when that sort of stuff tends to happen, especially if the equity market goes down with it as well.
Which it hasn't. That's the surprising thing. Last year it did, but this year...
This year it's come back, but I mean it's still, when you look at the relative ranges, it's still 10% off the lowest.
Mo, they come in and they say low valuations, it's a great opportunity to buy stocks.
Yeah.
Now, it's always the lemming herd, isn't it? The herd mentality, because fundamentals are not strong at all. You can look at a chartist view and they say it's fantastic. You're a doctor of maths, I keep pointing that out, but you are a PhD in mathematics. So looking at the logical way of looking at this, these markets, as Deb pointed out earlier this week, does not add up. There's panic in the markets in some places, and yet spreads ballooning out, but the equity markets don't reflect that.
I think the reality is this, that liquidity trumps fundamentals, and it always has done. I think the other thing is that there is a lot of reflexivity in the market as well, so that when you get an equity market rally, you actually cause the economic fundamentals to turn by themselves. I think the third point is that the market had already been pricing in a huge amount of bad news. For example, in Asia, most, in fact all markets were pricing in negative earnings growth into perpetuity. Now, if you believe that, then we probably shouldn't be here at all. But that is definitely not the case. And what is happening is the market is very much normalizing, still below mean valuations. I mean, if you want mean valuations in Hong Kong, you're looking at something like 26,000 on the HSI.
Yeah, but certainly, I mean, if you look at how Asian markets have done, they have broken above these resistance levels. And I guess, has your underlying outlook changed, or do you think it's really more a function of liquidity? And the reason I ask is, if it's a function of liquidity, then we could see outflows just as fast.
I think the outflows aren't ready to come yet. I mean, if you look at what is going on in the world, you've got central banks across the world adding liquidity or promising to add liquidity. The Fed has said they're going to do QE3 if it's needed. The ECB's adding, the Bank of England added yesterday, the Bank of Indonesia cut rates. Nobody's really on a tightening cycle. Real rates are negative across most of the world, and we saw the comments from some very well-respected people saying, bonds are the most expensive thing in the world. You've got to get out of bonds. You've got to go 100% into equities.
I believe Warren Buffett said they were dangerous. Yeah. Can bonds actually be dangerous, though?
They can if they lose you a lot of money.
Really? But will they lose you money this year?
I think probably not this year, because the Fed is going to continue with its twist program. But after the twist comes to an end in June, then potentially, let's see what happens. Certainly the U.S. economy if the jobs market is to be believed, has turned a corner.
There is a divergence, isn't there, Zeb, right now? Because we were speaking to Larry Fink, who said it'd be 100% in equities, but then you have someone like PIMCO's Bill Gross, who's been upping his Treasury holdings the most since 2010.
I think we're ignoring the elephant in the room, which is what the heck is going to happen with Greece in this debt drama. I mean, kicking the can down the road, the EU ministers today want more concessions from Greece, and they have until next Wednesday to get their act together. Do you think they will?
I think that whatever happens, you've got to remember there is a lot of posturing that may be going on in Greece, both from the European side as well as from the Greek side. You know, there are elections in Greece in April as well. So there's a lot of movement that is going to happen. One thing that the Europeans have been very good at doing, though, is pulling a rabbit out of the hat at the 11th hour. You know, all the bad things that people said were going to happen in 2011 actually haven't come about. And in fact, 6 months ago, if you said that the S&P was going to be on the verge of a fresh post-crisis high, I think most people would have laughed you out of the room. But that's where we are right now.
But it could also well be that they are pushing just these disasters from happening. It didn't happen last year. Yeah. Of course, we have Greece, and after Greece, when we were past that hurdle, then we had the rest of Europe as well. And do you think that they are just, like Zeb was saying, kicking the can down the road?
Well, for sure, but what that does is it buys you time, and it makes the problem smaller. You know, if you get, for example, like we all know with our own personal debt, you know, you just hope that inflation takes off. So that the actual real amount of debt is decreased over time, and that makes it far more manageable. So yes, you know, they are doing that. They will continue to do that. It's not to say that even if there is going to be a problem, let's say in September or October, that there isn't a lot of money to be made between now and then. Remember, you've had a bull market, a bear market, and a bull market again within the space of 12 to 18 months.
That's right.
So that hasn't addressed the Portugal situation, or the Spain situation, which is just next. That's next on the table, isn't it?
Well, I think one thing that is a relief here is that we're not all bullish. The fact that you're asking me about these questions shows you that there is a significant wall of worry that is out there.
Bigger worry than Greece.
Bigger worry than
economies.
Greece. In fact, most of the fund managers that I'm speaking to across the region, what they are saying is the way you value the market is you take average valuations, apply a 30% discount to what's going on in Europe, and that is one of the reasons why they're selling the market. But what they're finding is that all the things that they are selling are actually moving higher very aggressively in very low liquidity.
Mo, thanks again for joining us right now. Mo Apabhai, the head of trading strategy at Citigroup.